Welcome to Business Watch. Well, financial services firm PwC's annual survey of listed company executive directors released yesterday showed that though the representation of women in CEO and CFO posts has improved, women still occupy just 19% of top finance posts in June, up from 17% in 2021. Across the JSE, female CEOs constituted just 8%, up from 5% a year earlier, while CFOs at 22% from 17%. Among the locally listed entities, the female representation at executive level stood at 15%, moving up slightly from 13%. As the world teeters on the edge of a global recession and everyone gets to grip with stagflation, there are a few very interesting facts which relate to pay that do emerge from the report. And to discuss these, I'm joined now by Lawrence Grubb, who's Managing Director of Kokekla Remuneration Advisors, Ray Harraway, a member of the Institute of Directors of South Africa Remuneration Committee Forum, Johan Bertus, who heads Baker & McKenzie's Employment and Compensation Practice in Johannesburg, and Leila Ibrahimi, who co-leads the PwC Reward Team, which forms part of PwC South Africa's People and Organisation Division, and also editor of the report. So, Leila, glad you could make it, and it really falls on you to kick us off, because PwC's research suggests that South Africa's skills shortage and the bidding war for talent is really contributing to the dearth of women executives who tend to stay in their posts for shorter stretches, with female executives spending 1 to 5 years in their roles compared with 3 to 8 years typically of their male counterparts. How can this be addressed by listed companies?
Thanks, Michael. Yes, unfortunately, the data is not improving as quickly as we would have hoped. And what we've really tried to do this year is investigate in a little bit more detail the areas where we think change could really be happening or should be happening. So, as you've alluded to, we did the research from January 2020 to July 2022 to see how many new executive appointments were there on the JSE, and the number was 208 new executive appointments were made during that period of time. And unfortunately, only 25% of those were female. So we really saw that as the primary area where the change that we need can actually be brought about. You've already quoted the stats in terms of gender representation on the JSE. And we know that the first step to getting the gender pay gap right and getting it fixed is actually having female representation rather, at those uppermost roles and at those executive levels. So to answer your question in terms of what can we be doing, what should we be doing, we think first and foremost, succession planning and making sure you are developing that internal pipeline needs to be addressed. It needs to be really actively looked at and not just an afterthought. And really a well-developed succession policy is going to be key to that. I mean, we have a few other suggestions and ideas. And just to throw another stat in there, of the new appointments, the female appointments that I've cited, the 25%, interestingly, 60% of those, so 60% of those were internal appointments, which does show that in order to move the dial on this, we really do need to be looking internally and creating that talent pool of female senior leaders and executives that can feed into the executive positions that we want to see them fulfilling.
Yeah, it really does boil down to that succession planning. Ray, what are your thoughts on what companies are doing? And clearly progress is being made, but there are some sort of structural challenges, as I pointed out, that attrition and the fact that very often you see the top talented female executives poached, and there's a certain premium, I think, placed on that talent in the market.
Yeah, so I was really just reflecting on the fact that there was an improvement in the representation of females at senior levels, which I think is, obviously moving in the right direction. But what I think that the HR community is realizing, it's not sustainable to continue trying to buy the talent. That's the revolving door of a limited pool. And the emphasis is now on building talent. So talent pipelining is, what, Leila, you referred to. It's a competency that, I think organizations and employers are realizing is critical. So you sit down and you build, succession plans and bench strength around female talent. And that's something that is only going to become more important. So building talent with a focus on females is the way to go, as well as underrepresented groups, basically.
And Johan, if you look at that, I mean, that really stood out for me. If you look at that figure of, if you look at the top 100 companies, and where it was interesting to note that 21 females who were appointed into those executive roles, a full 60% were internal appointments. So this internal talent pipelining does seem to be a big focus at the moment. When we look at this issue of retaining talent, though, I think especially in an environment post-COVID where we've seen the great resignation, that seems to be more of a knotty issue for companies to try and get that balance right of retaining their top talent.
100%, Michael. And I mean, that speaks very nicely to this whole issue of the gender pay gap, that still exists. And how do we not only attract, but also retain our top talent, and specifically our female talent, where, at a very high skills level, they are exceptionally high in demand and sought after within the market. So, I mean, to contextualize this, if we look at the progress we are making as a country on representation on board level, for instance, it's more or less aligned with the general statistics in respect of North America and Europe, but which is hovering around about 29-30% as well. But I mean, if anything, that is just an indictment as to globally, the progress that we still need to make. It's not something that we should be self-congratulatory about and saying, listen, we're keeping tread with our developing partners. It should be an inspiration for us to do more. If we look at the gender pay gap statistics, surprisingly, South Africa seems to be doing better than a number of our trading partners. On the World Economic Forum statistics, South Africa is 18th on the gender pay gap rankings. Ahead of countries such as the UK, the US, and even countries like the Netherlands. The Scandinavian countries top that. So clearly, from a gender pay gap perspective, there is more that we can do in order to make sure that this homegrown talent that we have in our pipeline coming through remains with the organization and stays and assists us to achieve our representativity at executive and at board level. But there's some really other interesting developments as well that speaks to how we address those gender pay gaps. Some of the states in the US, for instance, there are 19 states in the US that have implemented salary history bans, for instance. To say that you're not allowed to ask an applicant for employment for salary data information, for instance. And there's some really good research that underpins that, to say that how this especially negatively impacts on women and people of color. So what we find is that employers perpetuate old practices by asking the female candidates, to use this example now, for past salary advice, and then just remunerate them slightly better than that, instead of giving them commensurate remuneration with their male counterparts. So when we look at gender pay gap as a factor that impacts on representation at top level, there is much more that we can do. We're not doing as badly as some other countries are that are comparable with us. But I think it could be an interesting development to see whether we go that route of implementing salary history bans, and how that perhaps ties in with Lawrence's issue, of the impact of the Companies Amendment Act on directors disclosure of directors' information.
Yeah. So on that point, Lawrence, because it is on the table still to disclose the differences between the CEO and the bottom, or the lowest paid worker. And we know it's a marquee bill of the Trade, Industry and Competition Minister, Ibrahim Patel. It's come under some criticism. The question I would have is, what is the right benchmark? If we are then to ban historic data in an environment where you want transparency and you want these things to be fit for purpose, how do we go about doing this?
Sorry, you go, Lawrence.
Go ahead, John.
No, Lawrence, it was addressed to you. Yep.
Okay. I think the Companies Amendment Act bill, I think that's a very big challenge there, because they don't specify exactly how it's going to be calculated. And there are so many differences in how you do it. If a company is operating in many different countries, how do you calculate it in different currencies, etc., cost of living? Also, do you take the CEO's guaranteed pay, or do you take the short and long-term incentive as well? Do you take it at target levels? Do you take what's actually vested and been received that year? So there's many discussions that still need to take place, I think, before we arrive at a sensible calculation, but certainly within each company, you should be doing that calculation and doing on a number of different ways and making sure that you understand the direction that that's taking and why. But just getting back to female representation, I was at a Remuneration Committee meeting this morning, a large mining company with operations in many different countries. And as part of the long-term incentive plan, they presented the next 5 years per country in terms of what they're going to be doing for gender representation to increase the female representation at different levels. And that's really something now that is on more and more agendas of companies that I'm seeing. They're taking it extremely seriously. They are really trying to bring more females into leadership positions, as well as the remuneration gap, the gender gap. It's also something that we monitor at that Remco. Their gap is actually very minor, very minimal. They've already done a lot of work to eliminate that. And, you know, just to reflect that, I think the survey that Leila, PwC, have produced is accurate. But I think within the greater number, there's a lot of companies who are really fairly well advanced in trying to address these issues.
And but the bottom line is that the overall number is still moving at a pace that doesn't require any kind of self-congratulation in our context. Now, the ESG, I mean, this is a big part of ESG, isn't it? And I think we're almost overwhelmed, Leila, with ESG at the moment. There's been, I get the sense, chatting to people in the market, something of ESG fatigue out there. But it is still critically important. So how are Remcos grappling with these questions around ESG, maybe linking KPIs to ESG outcomes when it comes to gender representation, for example?
Yeah, so you're right. It is a little bit overwhelming, but it's definitely something that has been talked about a lot, and now we're actually seeing action happening. So globally, PwC has done research in terms of how many companies are now linking ESG to or to remuneration, particularly the executive remuneration outcomes. And it's clear that the majority of companies, if we look at the UK and the US, for instance, are doing that. So we had a look at the South African top 40 and said, okay, well, what are we doing locally, and how many companies out of those are actually linking ESG strategy to their short-term incentive and long-term incentive outcomes? And we found as well, it echoed what we found overseas, which is that the majority, so I think it was 34, 35 of the 40 were linking ESG to the short-term incentive. But it was 37 for the short-term incentive and 34 for the long-term incentive. And that's bringing in an ESG metric in a weight as a weighted component of the balanced scorecard to calculate the short-term incentive or the long-term incentive. So in terms of gender representation, yes, that definitely forms a big part of the S of ESG and the gender pay gap, things like income inequality and the pay gap, speaking wider than the gender pay gap, definitely form part of the S. At the moment, the disclosure in the REM reports isn't that granular to actually discern, if there is an ESG weighting. Quite often it's a scorecard approach, or it's I want to say, vague description of an ESG metric being taken into account, rather than a granular target-based metric or measure, which is in there with, for example, a threshold, a target, and a stretch, which isn't to say that it isn't there. The fact that we don't have the disclosure doesn't necessarily mean it isn't being done. It just means that it isn't, the targets are not necessarily being disclosed. And that, of course, is an area where shareholders can criticize as well and say, well, how do we know this isn't a soft landing? How do we know that this is actually calibrated in a way that's robust? We talk about, when we are advising on linking ESG to remuneration outcomes, you need to make sure your targets are calibrated appropriately. You need to make sure that it's truly exceptional performance, or something which is moving the dial, which is resulting in pay outcomes. It's not just balancing out the financial metrics with a softer non-financial target. So it isn't the evidence of having targets, and I think it's right that if we are to move the dial, we do need to have some sort of, this is how many, as Lawrence has just mentioned in this example, this is what percentage of female leadership we are targeting. 40% is is often a number that's used as a stretching but achievable starting point. Also things like having a female in one of the top leadership positions. So we often talk about CEO, CFO, and chair. We want to target one of those positions at least to have a female sitting in that role. And of course, associating a time period with that. Those are all really important in order for us to see the progress that we're looking for. Otherwise, we're going to continue to report the same thing year after year. Progress is slow. And in the absence of any legislation, I mean, you just mentioned the Companies Act. It was a glaring omission, I think, that we didn't have anything on the gender pay gap in the Companies Act amendments that were proposed. It was just the top to bottom, the top 5% versus bottom 5%. So in the absence of that external legislation, companies are going to have to take it upon themselves to put into place voluntary targets. At the moment, we're not seeing that. So yes, there is definitely a presence of ESG, but in terms of gender representation, there were a few mentions of it in the research that we did, one or two. But certainly we couldn't discern from the publicly available data how many have those kinds of targets that we're talking about. And my conclusion from that is that they are not there, because if they were there, they're the kind of target that you need to publicly disclose and hold yourself accountable to.
Is it a challenge, and to bring you in here, Ray, of when we talk about ESG, it's often capital E, maybe capital G, small s, because it's easy to measure your emissions, scope 1, 2, 3 emissions. It's perhaps easy to report on how you're complying with the King codes on governance. When it comes to social metrics, the taxonomy still seems to be somewhat unclear, even though we know the outcomes of closing the gender gap are fairly straightforward and obvious. What do you see as some of the challenges around linking ESG to remuneration?
Yeah, I mean, it's always been environmental, the easy one to tackle and link with pay. The climate movement is bigger than any of the other SMGs at the moment, I would argue. So, I think that the G, however, is one that has the least traction in linkages to pay. And there's probably good sense for that. So let's tackle the G. G we see as, this is governance. Governance failures are typically tackled through malus and clawback provisions in any event, right? So you don't need an additional layer of trying to put G into pay. It's already there through the malus and clawback. So that's how we dispense with the G. And I think the report by PwC backs that up, that like only 16% of companies use G, explicitly linked to pay. The S is the difficult one, I agree. I mean, so the minute you start linking E and S into pay, you need to be able to have measurable outcomes that are even verifiable or subject to some kind of assurance. And, so you've got employment equity targets or diversity and inclusion targets that you can have. You can have internal pulse surveys in the organization that show how you move the dial on some of these things. So you can get to some kind of, let's call it defensible metrics that you can include. I don't think it's actually insurmountable. So people are starting to tackle, the sort of gender pay gap or the representation of underrepresented groups as a target to measure. That's measurable. So I don't think that can be used as an excuse anymore, that it's just too broad or too vague. Companies are getting their heads around this one quite well.
Yeah, and to Johan's earlier points as well, we're making great strides in the global context of closing that gender pay gap, which I think is something we can be rightly proud of. Just as we've got 4 minutes to go, I want to go around the panel just to get your concluding thoughts. It's Women's Month. We are making great strides, but what would your advice be to viewers out there who hold positions of leadership and influence to help speed up the transformation from a gender perspective inside corporate South Africa? Because I'm not one who believes that women have a particular skill set or men have a particular skill set. But what I do believe is we live in a changing world, a dynamic world, and you need a diverse range of views and opinions around the board in order to navigate this ever-changing world. Johan, what would your advice be?
Michael, I think the reality and the facts suggest that women are underrepresented in leadership positions, and when they are in the leadership positions, they are underpaid. Those are two measurables that, to Ray's point, we can and should address because these are measurable outcomes. The best advice that I would give to a new board or to a new CEO is this needs to be driven from the top. There has to be buy-in from the board and from the executive team in order to manage that. And then it should be trickled down to every managerial level and make it part of every manager's key performance areas to say, within your area, you need to ensure that we address both the representation gap and the gender pay gap within your area. Make it measurable, reward people for doing it well, and withhold incentives from those who are not playing the game.
Ray?
You know, any self-respecting HR team will know it is common sense to get the pay gaps right, okay? And because fair pay outcomes are what we say contribute to a fair and inclusive culture. And you know, so a more productive workforce is going to result. I think that's very, very clear to like I say, any self-respecting HR organization. There's a fatal mistake that people make, I think, in trying to legislate ethics. We already have very good legislation in the Employment Equity Act with the regulations on equal pay for work of equal value. It's actually addresses everything we've talked about. It addresses gender pay issues and race pay issues, etc. We don't need Companies Act legislation to come and do what is already there, in my view. Last point I would like to make, though, Michael, is when we talk about gender pay gap, there's a mistake people make is you take the pay of all women and average it, and you take the pay of all men and average it, and you work out a difference. When there's an underrepresentation of women in the senior roles, you're going to get a difference by definition. You should look at the gender pay gap of women in the same roles as men and then calculate what the gap is. And sometimes that's not the case. That's not done like that. And the UK does this gender pay gap as an average of all women and all men, regardless of the role that they're in. That's wrong, right? You've got to start with representation in the right roles, you know, to make the comparison equal.
Apples with apples. Leila, we've only got 2 minutes to go, so I think we'll end with you.
Sure. You know, I would probably steer the viewers back to our report, because I think that all of my advice is in there. But to quickly go over it, and I think Johan and Ray have covered some of the points, it's about getting your KPIs right, making sure you have those targets. I've mentioned a couple of examples earlier. Getting your succession planning policies right, making sure it's robust, it's not an afterthought, it's in there. Making sure your organizational culture is looked at and you've considered that so you can retain the females that you're now developing. And then lastly, making sure you have a supported policy framework. So again, this has been mentioned a couple of times. One of the examples was previous pay and disclosure of previous pay. So you've got to look at all of your policies, make sure they're all conducive to what you're trying to drive and achieve.
Thank you very much. That was Leila Ibrahimi, who co-leads PwC's reward team, talking about their most recent director's report, joined around the table by Lawrence Grubb. He's Managing Director of Kokekla Remuneration Advisors, Ray Harraway, member of the Institute of Directors South Africa Remuneration Committee Forum, and Johan Buerters, who heads Baker & McKenzie's Employment and Compensation